Everybody has heard of stocks and bonds. Let's just go through and make sure we're on the same wavelength. When we talk about a stock, we're talking about ownership or equity. So a share of stock represents a portion of the ownership in the company. And we're talking about a bond, we're talking about a debt situation, a debt instrument. And so when we're talking about bonds, there's a couple of terms we need to know. The principal or the face value for a corporate bond is oftentimes $1,000. A maturity date is included. A maturity date is when this principal, this $1,000, becomes due. You can talk about a coupon rate. That's established in the court document. It's a fixed rate. It's in the prospectus. And there's a trustee. A trustee acts on behalf of the bondholders if there's a problem. So the correct relationship is that you and I are lending money to the corporation or to the government, and therefore we're called a creditor, and the corporation or the government is the debtor. This is the essential relationship to understand. A bond makes two basic promises. One is to pay the principal at $1,000 at the end of the maturity date. The second promise is to pay a periodic interest payment, and that periodic interest payment is based off the coupon rate. And so in these examples, I'm using 5% as the example. 5% of $1,000 would be $50, so we're talking about $50 of interest every year until the maturity date. So as the bondholder, if you wanted to know how much you would get at the end of the maturity date, you would multiply the number of years, 20 years, times the $50 to get $1,000 worth of interest, and at the end of the 20 years you would get the $1,000 principal. And on the timeline here you can see that every year the bondholder's getting that $50 payment. As an aside, I'm not putting all 20 years worth of $50 in there just to keep the timeline from getting gunked up. But when you're looking at what the value of this bond is, in other words, we're asking what's the value of those two promises. So you're asking yourself at the end of year one, what's the present value of the right to receive $50, and so that's what this one is. At the end of year two, you're saying what is the present value of the right to receive $50 at the end of year two. And likewise, if we're over here to maturity date, we're saying what's the present value of the right to receive $1,000 in year 20, and you have to bring it all the way back here to the present. So if you added all of these things up, it would be the present value of a future stream of payments. And that's how the stock market or the bond market knows what the intrinsic value of the bond is, and then the actual value would be determined by daily supply and demand factors. It's not so important that you understand present value, but in case you do, here's what the relationship is. If you have a big interest rate, a big discount rate, it makes for a small present value, and the opposite is true. If you have a small discount rate, then it makes for a big present value. Sometimes it seems a little backwards, but that's the correct interpretation. So in this pane we see what the basic formula is for the bond yield. The bond yield is equal to the interest payments, that's the $50, and I've got a blue bar over it. It means that can't change. Once it's in the prospectus, it's there for the life of the bond, divided by the market price, and the market price is simply what anybody will pay for it. And you see the common fraction there is 3 is equal to 6 divided by 2. I'm just using that for an illustration. If the 2 was to go down to 1, then the 3 would go up to 6. Or likewise, if the 2 was to go up to 6, the 3 would come down to 1. So all I'm trying to say is that the 3 and the 2 are inversely related, just like the bond yield here is inversely related to the market price. And the common sense of it is if I can get the two promises that a bond makes, if I can get it for $700 rather than $800, it must be a better deal for me. In other words, the yield to me must have gone up because I got it for a lower price. There's another important relationship that establishes a direct relationship between the prime interest rate and the bond yield. So if something happens in the macro economy that causes the prime interest rate to go up, it means the bond yield's going to have to follow suit. And in the reverse, if something happens in the macro economy that causes interest rates to go down, then the bond yield has to also go down. And you can think of it as, suppose you're in a classroom and the classroom you're in says you can borrow money at 5%, and across the hall it's going to be 6%, and down the hall it's going to be 7%. Well, you would never go to those other places. You would come to your own classroom because that's the lowest price. And the reason for that is that in a sophisticated financial market, everybody knows the price of everything. So here's an example. I'm using the 5% coupon rate, and I'm assuming I paid $800 for the bond. And so 5% of $1,000 would be $50 of interest payment, and if I divide the $50 by the 800, I come out with a percent of 6.25%. And I'm making the assumption, suppose something happens in the economy and the prime rate falls to 5%, then what has to happen is the bond price has to rise up to $1,000. And you get that by looking at the formula. So remember that the bond yield is equal to the interest payment divided by the market price. So we know the interest payment, the numerator, is $50, and we know the yield has to be 5%. So if we multiply the yield times the market price and come up with 0.05x equals 50, and then solve for x, we see that it's $1,000, which would be $200 worth of a paper profit. If you wanted to keep the bond till the end of the maturity date, you could, but you don't have to, because now you've just made $200 of a paper profit. Here's the same example, but we're looking at a loss. So I've still got a $1,000 bond with a 5% coupon rate, and I paid $800 for it. So $50 divided by $800 is 6.25%. And now I'm assuming the prime rate increases up to 7%. If we go through the same calculation, we see that the bond price had to have fallen to $714, which means there's now a paper profit of a paper loss of $86. So in all of these, we're seeing this inverse relationship play itself out. So to summarize, if you're talking about a common stock, they pay something called a dividend payment, and that is voluntary based on the company's decision. With a bond, they make an interest payment, and it's a mandatory payment, and the trustee acts on behalf of the bondholder if they don't. Bonds are generally safer than stocks, and in case of a liquidation, bonds are higher up on the priority list than stocks. But as we've just seen, bonds are highly sensitive to a change in interest rates, and so you don't think of them as no risk, you just think of them as lower risk. When talking about bonds, we wouldn't be complete if we didn't talk about a safe haven, because that's been happening now. Money all over the world, when there's uncertainty, money looks for safety. And one of the safest places in the world is the United States market. And one of the key barometers is the U.S. 10-year Treasury bond. So a lot of other rates, like mortgage rates, are based off of this 10-year rate. So it's a key barometer in economic statistics. And as of early 2016, there's been an increased demand for these 10-year Treasury bonds because there's a lot of uncertainty. So what has happened is the yield has gone down to its lowest level in a long time. Again, all we're saying is that there's this inverse relationship. It's also important to understand the element of risk. Risk is involved in every financial decision you've ever made. It's unavoidable. So nobody knows the future. We all look at the daily news and we make our interpretation about the future, and based on our preference for risk, we either want to buy something or we want to sell something. Well, that's the good news, because it means that there's players on both sides of the market. There's a buyer and a seller, which is a good thing. So this completes our talk about bonds, and you should try to become sensitive to it, because it's a key factor in anticipating what's going to happen in the future. Thanks.